Here's the surprise catching thousands of Australians out this tax time. The return you lodge in 2026 is still taxed on the old 16% bracket, not the new 15% one you keep reading about. On a $90,000 salary, that's roughly $268 more tax than the new rate would give you, according to the 26 to 27 federal budget figures. The cut is real. It's just landing a full year later than most people assume, and I'm going to show you exactly why. So what actually happened? The 26 to 27 federal budget confirmed the marginal rate on income between $18,201 and $45,000 falls from 16% to 15% from the 1st of July 2026. The catch is that Australian income tax is assessed by financial year, and the return most of us lodge in 2026 covers income earned from July 2025 to June 2026, which still sits under the old settings. This matters because a budget announcement and a tax return year are two different things. The change starting the 1st of July 2026 applies to the 2026-27 income year. The return you'll actually lodge around the middle of 2027. Your current 25 and 25-26 return still runs on the existing Stage 3 framework, with a full 16% on that lowest taxed bracket. So who does this hit? Essentially anyone earning $45,000 or more this financial year. Your 2025-26 return still charges 16% on the slice between $18,200 and $45,000, and the switch to 15% worth up to $268 a year according to the 2026-27 budget only starts once you cross into the next financial year on the 1st of July. That $268 figure is the exact gap between the old 16% and the new 15% across that first taxed bracket, according to the 26-27 budget. It's a genuine saving, but it belongs to the 26-27 income year, not the return sitting in front of you. This is general information, not personal advice, so check your own circumstances. And here's the part people miss most. The headline extras don't apply to this return either. The $1,000 instant work-related deduction, expected to help around 6.2 million workers with an average $205 saving per the 2026 to 27 budget, only starts from the 2026-27 year. And the working Australians' tax offset of up to $250 doesn't kick in until 27 to 28. None of that lands on your 2025 to 26 return. So what should you actually do? First, jump onto the ATO's tax rates page and confirm the 2025 to 26 brackets so you know your income is taxed on 16%, not 15%. Second, log into MyGov, check your income statement, and compare the tax withheld against the 2125 to 26 tables so you're not blindsided at lodgement. Third, mark on a calendar that the instant deduction starts 2026 to 27 and the offset from 2027 to 28. This is general information only, not personal advice. Check your own situation or speak to a registered tax agent. Lock this date in. The 1st of July 2026 is when the 15% rate switches on, and it flows through to the return you lodge around the middle of 2027. If this kind of plain English breakdown is useful, subscribe. There's one like this every week. Before I wrap up, the most counterintuitive piece of this is what comes next. The cut doesn't stop at 15%. From the 1st of July 2027, that same bracket drops again to 14%, worth up to $536 a year versus the 21-24-25 settings according to the 2026-27 budget. The ATO updates its withholding tables each year, so watch for the new tables landing from the 1st of July 2026. So the bottom line, your 2026 return is on the old rates and the good stuff starts a year later. Next, I'm breaking down exactly how the new Ponhus July 2026 withholding tables will change your fortnightly take-home pay, dollar for dollar. If you want to catch that one, subscribe so you don't miss it.